Thank you, Mohit. Very warm welcome to everyone joining us today from across geographies, online as well as in the room. Turning to a performance for the third quarter for fiscal year 26, this was a very well-rounded quarter, with majority of our growth engines coming together to deliver a very strong set of results. Our revenue for the quarter stood at 1610 million US dollar, representing 1.5% sequential growth and a 2.7% year-on-year growth on a reported basis. On a constant currency basis, adjusted for FX, revenue increased by 1.7% QOQ and 1.3% YoY. In rupee terms, our revenue was 14,393 crores compared to 13,995 crores in the previous quarter, instead of increase of a 2.8% in sequential basis and 8.3% on a YoY basis. For the quarter, our operating profit was 211 million, with operating margin expanding close to 100 basis point to 13.1%, marking the ninth consecutive quarter of margin expansion. Gross margin expanded by 120 basis point QOQ, driven by improved productivity and volume growth. In INR terms, operating profit reached 1,892 crores, representing a robust year-on-year growth of 40.1%. These results reflect disciplined execution, sustained focus on efficiency across the business while maintaining momentum in top-line growth. Other income for the quarter was at a loss of 2.4 million US dollar, primarily on the account of forex losses. As of December 31st, our hedge book stand close to 1.05 billion compared to 1.33 billion in the previous quarter. Our effective tax rate for the quarter was 25.7%. The normalized ETR for the full year stays close to 27%. Our profit after tax before exceptional items for the quarter was 9.2%, up 180 basis point on a YoY basis. The exceptional item for the quarter relates to the one-time provision of $30 million in accordance with the new wage code notification. Through disciplined capital allocation and sharper execution, we've strengthened our return on capital employed to 26.9%, reflecting the business that is not just growing, but growing efficiently. Our year-till-date free cash flow to operational PAT ratio is 123%, which gives a validation of a working capital unlock that we're delivering in the business. During the quarter, the free cash flow was 194 million, driven by strong collection efficiency and continued improvement in working capital management. Our DSO decreased by 4 days on a quarter-on-quarter basis, driven by reduction predominantly on our unbilled receivables. Our total deal wins in the quarter stood at 1096 million, reflecting a growth of 48% on a last 12-month basis. The quarterly deal win this quarter is the highest we've had in the last 5 years. As we move ahead, we remain focused on sustaining our operating rigor, strengthening execution, and delivering our F27 strategic goals, where we continue to remain on track. Thank you.
Thank you, Mohit and Rohit.
In Europe, in the communications industry. This really underscores the strength of our client relationships, the relevance of our capabilities, and our ability to deliver long-term value at scale. Before moving to our third quarter business performance, I just want to touch very briefly on this large deal win in Europe. This is a strategic engagement with a leading European telecom provider. It's one of the largest wins in the company's history. And the multi-year partnership is about a comprehensive modernization of the client's applications across both the CTO and the CIO domains. This is aimed at accelerating innovation, strengthening digital resilience, and achieving AI-led operational efficiencies. This has been enabled by our deep domain expertise and proven transformational capabilities. This win further strengthens our leadership position within the telecom vertical. So now, having given you some details on our mega deal, I just want to turn to our performance for the quarter. So revenues have grown by 2.7% year-on-year and 1.5% quarter-on-quarter on a reported basis, and 1.3% year-on-year and 1.7% quarter-on-quarter on a constant currency basis, making this our fastest quarterly growth in the last 3 years. Moreover, this performance has been driven by broad-based growth across communications, manufacturing, high-tech, retail, and healthcare. At the same time as we've grown revenues, operating margins have expanded by 290 basis points year-on-year to 13.1%, This really underscores the progress enabled by our improved operating discipline and the quality of our revenue growth as we have maintained pricing discipline and enhanced our revenue mix. For Tech Mahindra, the all-important communications vertical has grown by 4.7% year-on-year during the quarter. We are seeing signs of stability across the US, coupled with stabilization of top client spending. Europe is expected to move from a phase of stability into a growth phase supported by this large deal win that we reported earlier today. We believe the comms vertical is well positioned to be one of our growth verticals as we move into 2027. The BFSI portfolio has declined by 0.8% year on year, primarily due to higher than normal furloughs during the quarter and the passing of annual productivity gains for a large infrastructure contract in the rest of the world, which additionally impacted revenues, for the region. The long-term BFSI trends remain favorable, and we continue to make inroads in engaging clients with tailored solution offerings in this important vertical. And we continue to see good demand across digital transformation, customer experience, data and analytics, cybersecurity, and risk and compliance, coupled with AI adoption. Manufacturing continued its strong trajectory this quarter, building on the momentum from the previous quarter with a year-on-year growth of 11.7%. As stated earlier, we are seeing good traction in aerospace and in the industrial segments in the US, while in Europe, growth was supported by the ramp up of a large automotive client during the quarter. The US automotive segment continues to remain in a wait and watch mode, and we expect demand trends to turn more positive over the medium term. The high-tech vertical declined by 4.6% year on year. However, it showed positive momentum during the quarter, driven by engineering services, particularly in the semiconductor segment. That said, we expect the high-tech sector to remain volatile as companies continue to operate under cost pressure and continue to exercise caution in their tech and ops spending. Retail, travel, and logistics continue to perform, delivering 11.7% year-on-year growth. This has been supported by a strong traction in our logistics business and above normal seasonality in the BPS business for retail. On a geography basis performance, the Americas has grown by 2.1% year on year. Europe delivered a strong growth performance of 11.2% year on year, supported by the large deal ramp up in European auto that I spoke about. Revenue from the rest of the world has dipped by 4%, primarily on account of furloughs and annual productivity gains. That said, our priority markets within the rest of the world, and we have called out these priority markets, they have grown by 12.9% year on year. And this reflects our continued focus on selected markets, which should better contribute to growth in the future as our mix continues to shift. If we look at our client portfolio, we added three $50 million plus clients year on year into our 50 million plus client bucket, reinforcing the strength and scalability of our client relationships. Additionally, revenues from our 20 million plus clients. Now, as you know, this has been a key focus area for us, right? Growth in our top accounts. This continues to be significantly higher than the company average. And I believe strongly that this performance underscores our focused approach to scaling strategic accounts and deepening long-term partnerships by bringing tailored solutions to clients and applying the distinctive domain expertise of our experienced staff.